The CoinDesk Spotlight is brought to you by Nexo, the place to earn on Bitcoin, Ethereum, and more.
Welcome back. As the Three Arrows Capital fiasco continues to ripple through the industry, one of the many trouble spots is in the market for staked ETH, a special Ether derivative token which has recently depegged from its prior one-to-one relationship to the spot market value of Ether. Joining us now to explain the role of staked ETH in the meltdown of crypto markets is Daniel Khoo, a research analyst with Nansen, a blockchain research firm. Thanks very much for joining us, Daniel.
Yeah, thanks so much for inviting me. Happy to be here.
So before we get into this, I'm just going to give my layman's take on what we're talking about here, right? So staked ETH is the Ether that is locked up in the Beacon chain, one of the blockchain that's being built in parallel to the existing Ethereum chain, for the purposes of at some point merging the two as Ethereum moves from proof of work to proof of stake. But that Ether has to be locked up until that happens, which means it's not liquid, and therefore a market developed through the Curve protocol where people could actually trade this kind of derivative version of that, the StETH, StETH as people are calling it, for Ether, and that was trading more or less at one-to-one relatively comfortably for some time, but more recently it has broken down as people have tried to get out of that. We've faced all these liquidity problems. So you've got a thesis as to what triggered that, and you're talking really here about Terra. Can you explain what that thesis is?
Yeah, I think, on-chain investigation revealed that the contagion actually stemmed from the Depeg of UST, and subsequently, the collapse of Terra ecosystem was, likely the main factor for stake ETH to deviate from its one-to-one ratio. So from the time where, we had the Terra collapse, that's when stake ETH actually started trading below its one-to-one ratio and never recovered ever since. And going forward, when people actually unwinding their positions because, not only because of the collapse of a giant ecosystem, but, they're actually trying to de-risk their leverage positions in stake ETH because of, the poor market conditions and also de-risking as well. And, major entities such as Celsius, 3AC, who had positions in UST, Luna, when they actually lost quite a bit of money and affected their financial health, they also had to, unwind their other leverage positions, especially in stake ETH as well, which further caused, an effect on the discount that they are trading at today.
Yeah, just this classic contagion and liquidity problem when you get into these leverage cycles. Everybody has to deleverage, it seems to me. There's a chart in your report that we'd like to show. Maybe that'll help us to talk through the sequencing here. It shows a link between the volumes that we were seeing and then the fall in the price, which shows the depegging from around one-to-one down to, sort of 0.93 now. This looks like there were two moments there. Can you explain what those periods represent in your mind?
Yeah, so actually the first period, I think, as we all know, is the period where Luna and UST actually collapsed. So that's when the first major volume actually we see on the chart where the price actually start depegging because, people were actually moving off their stake ETH equivalent in Anchor, which is called a B-Ether, where they actually push it back to the main chain because of all the security risks that, the Terra ecosystem poses. And that's where they actually traded it back to Ethereum. And because of the market collapse, many people actually sort of de-risking as well, so changing back to Ethereum. And the second one is actually sort of like the contagion effects like we see today. Many, big players, 3AC, Celsius, Amber Group, where they're actually trying to unwind their leverage positions in stake ETH. And that's when the second big volume, and we actually see major downfall in the price of stake ETH in terms of Ethereum as well.
So just looking kind of at the bigger picture here, similarly to what we asked our last guest, what might have been done to prevent this? If you could focus on some of the factors that, could have led to a different outcome, just so we can sort of learn from for the future, what would you say that they are?
Yeah, I guess this is both for traders, investors, and also the retail side as well. So I think firstly, as cliche as it sounds, education and knowing what they're investing is, because they're actually trading stake ETH, which is actually them staking the Ethereum on the chain, and this they only can trade it back to Ethereum when the merge happens, or they can actually sell it off in the Curve liquidity pool. And they actually have to identify that, all this, there's also a certain amount of liquidity that can be drawn. And that's why, the price actually change when, there's actually big sells into shallow liquidity, and they might actually stand to lose money as well. Secondly, do not over leverage and have proper risk management put in place so that you do not get caught up in illiquid situations where you actually have to sell your positions in unfavorable market conditions. And thirdly, and the most important thing that I feel that everything on chain is transparent, but CeFi such as Celsius, where it's actually very opaque. You can't track what is going on, and users of such platforms are not aware of where their funds are actually going to end up, and in some cases have no control over the funds in situations where things go wrong. And for DeFi, I would love to say that if it's on the chain, it's definitely on Nansen, and users can actually learn more about data analytics, how to do proper due diligence through on-chain analytics tools. So I guess one example in relation to StETH, they could actually identify the major stakeholders in the StETH pool in Curve, and also set up alerts, track the movements and activities of such stakeholders. So if there's a mass withdrawal and you're concerned of your positions, you could be the first one to be alerted. You can unwind your positions and also not be caught up in such contagion as well.